One can improve.
Okay, now it's going on. Okay, fine. So Rainer, we'll let you now to open your presentation, okay?
Okay.
Mm-hmm.
So you disabled screen sharing.
Yes, no, I have enabled now. Just a minute.
Ah, yeah, okay. Perfect.
You can, fine.
Okay, let me.
So a few words in the beginning. I would like to say that, dear friends, dear colleagues, I'm happy to welcome all of you at our 9th seminar of our conference. So this time, as you know, our main speaker is Rainer Martin. He's the leading economist at the Joint Vienna Institute, and his topic is the monetary and regulatory response to COVID-19 in the euro area. And I would like to announce also that next time, in a week, we are going to have a conference on which will be devoted to social consequences of COVID-19 pandemic in Russia. And our main speaker will be Marina Pikhlakova-Parker and Vyacheslav Veniaminovich Lokosov. They are both from the Institute for Social Economic Problems of Population of the Russian Academy of Sciences, and Vyacheslav Veniaminovich is the head of that organization, and Marina is the senior researcher. So right now, I am happy to give the floor to Rainer Martin. Please, you are welcome.
All right, thank you very much, Alexander.
And I'm sorry, I would like to ask all of us except Martin to switch off our microphones so that we don't have interferences.
All right, thank you very much, Alexander. It's a pleasure to be back at MSE, at least virtually. That's the little pleasures we have these days in COVID, right? So, so thank you very much for the invitation, and a good evening to all of you. So I actually took the liberty to slightly change the topic of the presentation, because I thought maybe it's useful for you if I also mention a few things about the European Union's fiscal policy response to this pandemic. So you have a sort of holistic picture, so to say, of what has been happening at the European Union or Euro area level. So I will also make some references to policy responses at the national level, but only that's only a side aspect, so to say. So the focus is really on the EU level policy response. All right, then let me get started. So before going to the response as such, I thought it's also useful to set the scene a little bit and to say a few words about the state of health of the Euro area at the beginning of this pandemic. As we have all learned now, how healthy you are at the beginning of such a crisis makes a big difference, apparently. So this is, of course, the same for economies. So let me start here. Let me say a few words on this. So on the macroeconomic and monetary policy background, when COVID-19 struck at the beginning of this year, the recovery after the global financial crisis and after the Euro area sovereign debt crisis was actually well on track. And what was also very positive is that there was not a lot of heterogeneity within the euro area. So also the traditionally, say, not so well-off countries were actually growing reasonably fast. So that was a good thing. Now, having said that, the fiscal space remained, however, quite uneven. So in particular, some of the ex-crisis countries, I'm naming here Greece, but also I could mention Italy, they had still very high public sector debt. And that, of course, conditions what they can do now in response to to COVID-19. Monetary policy was very accommodative throughout this period. Quantitative easing by the ECB was still ongoing. So it didn't really withdraw from what it was doing before. Now, some people say this is a problem. Some other people say this is actually quite good because the crisis turned the ECB into a very modern, a very innovative central bank that used a lot of new monetary policy tools. And of course, they had this at their disposal. I'll get to this then in a minute. The financial sector was in relatively good shape. So the resilience of the banking sector in particular had strongly improved compared to, for example, 2010 to 15, to the early part of the last decade. But having said that, there were, of course, still a few risks or a few weaknesses. So, for example, euro area banks are not very profitable, and they haven't been very profitable for a while. And the share of non-performing loans, of distressed assets, was still quite high relative to, for example, the United Kingdom or the United States. Now, in the institutional structure, and this matters now, of course, a lot when given this new crisis, there was some progress. So first of all, the ESM has been established. The ESM is the European Stability Mechanism. This is a European institution that gives out loans to member states that are in trouble, euro area member states. So that was the first step. And then secondly, and maybe even more importantly, the banking union was at least partly put in place. So now in the euro area, there is a single banking supervision and there is a single banking resolution system. There is not yet a single deposit insurance, but these two elements, banking supervision, banking resolution, were in place. So that's all good news, but having said that, of course, what we are facing now with COVID-19 is an economic challenge like pretty much no other before in peacetime. And to illustrate that, let me show you this little chart here, which I took from the recent ECB financial stability review. And I think this says it all pretty much. So what you see here on the right-hand side of the chart, this normal distribution, pretty steep distribution, this is the growth expectations for the euro area for this year, 2020, in February. So just before COVID-19 hit. And this is, it's a distribution because it's a survey of professional forecasters. So it covers a lot of different forecasts, some more optimistic, some more pessimistic. And this is the range they were talking about. Now what you see on the left-hand side is where the forecast currently stands. And currently means a few weeks. Probably if we do this now, it would be even further on the left than it is there, right? So the forecasts here are ranging between -6 to -8-point-something% of GDP. And that is, of course, well outside even the tail of previous growth distributions. So it really is a challenge like no other. And I think that illustrates this quite nicely. Another way to look at this, and I would like to focus here more on the On the fiscal response, this shows you the change in GDP growth. Again, the forecast, this is the yellow line, and the blue line is the expected change in budget deficit, again, for the euro area as a whole. So also on this side, in terms of the fiscal challenge, it's absolutely massive what is to be expected. So the critical question in pretty much all of this, when it comes to forecasting, when it comes to trying to find the appropriate response in terms of magnitude, but also in terms of the nature, is of course, what is the shape and the timing of the recovery? So is it a more a V-shaped growth pattern that we are likely to have, or is it more an L shape? I think at the beginning in March, when the first analyses came out, everybody was very optimistic and says, well, this is likely to be a V. Why? It's an exogenous trigger. There is no large-scale destruction of any infrastructure. This is not a war, but it's also not like, for example, the global financial crisis, when everybody knew the financial crisis, the financial system would need to change. This is not the case. So everybody thought, well, this is probably a blip, a very deep blip, but it's likely that we are back on track relatively soon. Now we're in June, and we're a little bit wiser. And one of the things that has been established, at least in for the European Union countries, is that one single month of a lockdown, and most forecasters agree on this, costs around 3% of GDP, just 1 month. And most countries and most forecasters, I should look at the forecasts here, assume a lockdown period of about 2 months. And then subsequently, these containment measures are eased. So that gives you, which is still means you're not fully back to normal, but at least it sort of balances it out. This gives you the forecast of around 3%, of around 8% in total. Now, the problem is, of course, that when these costs are likely to be nonlinear, the longer it takes, the more you will get destruction of economic structures, firms, of people who are losing their skills because they're out of employment, so hysteresis effects and so on. So in particular countries like the European Union, which by and large are not as flexible as the US, for example, is, it may be that the total impact, especially if the containment measures need to take a bit longer than what was initially thought, are actually even worse, right? And of course, if you really want to go beyond that, if there is adverse medical developments requiring a second wave of the lockdown, or a long-term failure to develop effective vaccinations or medication, then of course the whole forecasts need to be revisited. But okay, let's not assume sort of a doomsday scenarios here. Let's hope that the one-off containment measures will be sufficient and that afterwards this virus is more or less under control. Let me here also mention one thing though, which is a positive aspect, and unfortunately I didn't put it on the slide, but I will mention it now. There's one very positive aspect in so far to this crisis, is that there is nobody obvious to blame. That matters a lot for the response in the euro area. When we talked about the euro area sovereign debt crisis, there was a lot of talk about, you know, some countries just spending too much because they are spending too much, they can't collect the revenues, or they do strange financial engineering, or Wall Street has messed us up. A lot of these blaming. People or sectors, countries were blamed. And that, maybe there was some truth in some of it, but it didn't matter, and it certainly did not help for the policy response. And this is not the case. I mean, nobody in the euro area or in any other, pretty much any other country that is affected by this can be blamed. So that helped a lot the euro area response. It put the policymakers in an easier position to do what they needed to do. So that's a bit the starting position and the outlook. Let me now talk a little bit about the various response areas. So I'll start with monetary policy, then move to supervision, and then to fiscal. And I have to apologize, a lot of what I'm presenting here is quite descriptive. There is no fancy analytics behind it. It's really just a stock take, more or less, on where we stand at the moment. But I think there are a lot of interesting issues here that can be discussed, because most, like in medication, most of these medications, economic medications that were used, have of course side effects. And on a lot of these issues, you can have long and interesting discussions. So let me start with the monetary response. Some observers said, well, what the ECB has done can be summarized with a nice sentence, same, but different. I would rather say it's more of the same and a lot more of the same. The ECB didn't really reinvent the wheel here, but as I mentioned earlier, it didn't have to reinvent the wheel. It had the instruments at its disposal already, given the fighting of the crisis over the previous decade, more or less. So it simply leveraged up, ramped up the existing instruments. And probably the most important of these instruments is the quantitative easing measures. So already in March, the ECB started what it was called its Pandemic Emergency Purchase Program. So when you deal with the ECB, there's a lot of alphabet soup, a lot of abbreviations. Sorry about this, but I try to explain what the individual ones mean. So this is a specific emergency purchase program due to COVID-19. Initially, it foresaw purchases of around 750 billion. This was on the 4th of June, so less than a week ago. It was increased by another 600 billion because the ECB realized, of course, that inflation has pretty much fallen to zero and that there is no prospect of inflation going back to its medium-term inflation target anytime soon. So this was the argument why even more liquidity needed to be provided to the system. So the purchases under this program will last until the end of June 2021, but ultimately it will depend, of course, how long the COVID-related recession will last. So there is a lot of flexibility. There's one important innovation here, though, which is that under this program, it's possible for the ECB to deviate temporarily from the capital key allocation. So what does that mean? The ECB is owned by the central banks of the euro area member states. So they have all a capital share in the ECB. And for its previous asset purchase programs, the ECB always did the purchases in line with this capital key allocation. This was in order to prevent the accusation that this is just for certain countries, right? Now, this can be changed. This can be temporarily focused on those countries where the impact of COVID-19 is the most severe. And that is really quite a positive, in my view, positive development. It's an innovation. That's something that didn't exist there before. There are a few other technical points which I'm not going to go into, but just to say that a large part of these net purchases will be, as in the past, in sovereign bonds. But the ECB has also expanded the list of papers that are eligible to be bought under this program. Right? And that is, of course, something that is probably needed because the magnitude of these purchase programs is quite stunning. And even before it was launched, some observers and analysts argued, well, the ECB may soon run out of paper to buy. Right? So this is a bit the background to this aspect. There's also an existing asset purchase program that was enhanced, that was increased, but there was nothing new here except for the. One other point here also to mention, this goes beyond Europe, but I thought speaking to a mainly Russian audience, it's probably something quite interesting. So we've seen over the last couple of months also a couple of emerging economy central banks becoming active in quantitative easing and starting to buy mostly sovereign bonds, but also some commercial bonds on the market in order to increase their efforts to support the economy. There's a couple of other measures that the ECB has taken. So two of them are long-term refinancing operations. That is nothing new. I think the ECB has done that since 2013 or 14, if I'm not mistaken. I think 13. So what does it mean? It simply means that market participants, the banks that participate in these operations, they get fixed rate full allotment liquidity for a long period, a relatively long period of time. For the normal targeted long-term operations, it's 1 year. For the pandemic operations, it's up to 16 months. And then that's an interesting point as well. These operations have a negative interest rate. So for the pandemic operations, because they are longer, it's a negative interest rate of minus 0.25. And for the targeted one, so the targeted one requires the bank to lend. It needs to prove actually to the ECB that it has used this liquidity to extend new loans. The rates are as low as minus 1%. So in fact, it's a subsidy that is given here to the banks. There have also been some changes in the risk parameters in the ECB collateral framework. That is also not something really new. It's something that has been going on for quite a couple of years. So if we rewind to the beginning of the sovereign debt crisis, basically the ECB would almost only accept AAA papers and mostly AAA sovereign paper. And that has been changed quite significantly already over the last couple of years. The newest changes are that the ECB now accepts government guarantees and banks' IRB credit rating. So IRB credit rating is basically a credit rating that is done by the bank's internal rating-based model. Now, why is this important? It's important because one of the effects that you're likely to see now with COVID-19 is, and you're seeing it actually already, is a big wave of downgrades in ratings by the rating agencies. Because they are using their standard model, of course. They may take the government guarantees as an alleviating factor, but it's clear that a lot of downgrades of the ratings will come, and they are coming already. And if this is something that would fully impact the acceptance of papers as collateral for ECB refinancing operations, it would be a problem for the liquidity provision. This is why this was done. And then there are a few other points, for example, reduced collateral valuation haircuts. So again, it's basically an easing of risk parameters. There's also some activity on the ECB side that it reactivated and enhanced currency swap lines with, I think at the moment, 16 different countries, usually non-Euro area EU countries, neighboring countries, or some other large industrial economies. Now let me come to a very interesting, maybe somewhat esoteric topic, but it really caught a lot of attention in Europe at least. So at the beginning of May, the German Constitutional Court ruled that the ECB had overstepped its mandate by not providing what it was called a proportionality assessment of its public sector purchase program. Now that program is very old. It dates back from March 2015, and this court case has been going on for 5 years, obviously. Now, the timing is very interesting because at the beginning of May, we were, of course, already in the middle of the crisis, and the ECB had already launched its big pandemic increase or pandemic-induced increase of quantitative easing. So when the German Constitutional Court decided this, there was at the beginning, by observers and by policymakers, quite a lot of worry that this may be able to undermine the activities of the ECB going forward. Now, the problem is not solved, and it's not over yet. But what has not happened is that there was any negative market impact. So, for example, spreads of more vulnerable euro area countries, sovereign papers didn't go up. So that's good news. It's also slightly disappeared now from the headlines, but it's certainly something that needs to be discussed because you cannot just simply ignore it. This is not the way the German Constitutional Court is working. So there is now a lot of discussion between mostly the European Parliament and the German authorities how to address this, because a German institution cannot directly demand something from the ECB that is not compatible with the European legal framework, and the German Constitutional Court didn't ask for this. So if it's of interest, we can discuss this maybe later on in a little bit more detail. I think it's quite an interesting development, but so far it was not something that undermined the response by the ECB. Let me then turn to supervision and regulation. And that is, of course, also the ECB, given that the single banking supervisor, the SSM, the single supervisory mechanism is part of the ECB. So I mentioned already at the beginning of my presentation that the situation here has improved quite a lot compared to, say, 2015. This gives you some figures to show this. So the capital ratios of the banks has increased considerably from around 13.5 to 14.8. So these are average ratios for euro area banks. Liquidity ratios have also improved considerably, and the share of non-performing loans has declined. So this is all quite positive. Now, nevertheless, ECB banking supervision has decided that additional measures would be helpful to assist the banks in getting through this crisis. And it's basically used three different types of measures to support the banks. The first and probably the most important measure is that it reduced the necessary or compulsory capital buffers that the banks need to have. So this chart here on the left shows you a little bit how this works. So this is the capital endowment of the euro area banking system. And it has basically three parts. So the minimum requirements, of course, this is not something that is changing much. The management buffer, this is spare capital, so to say. This is what the banks can use anyway to deal with downturns in the business. And the important part is what is here the yellow bit, what is called CBR. This is the combined buffer requirements, and P2G. P2G stands for Pillar 2 guidance. So that's obviously smaller after the decisions, and in total, these decisions to release certain capital buffers have freed up to 140 billion of capital for the euro area banks. So this is additional capital they can use if needed to deal with losses before they are coming to the limit of supervisory requirements. So that is quite significant, I would say. There was also some relief measures for liquidity requirements, and there were also some measures allowing the banks to use slightly lower quality capital instruments, but I don't want to go into details of this. So another important area was the treatment of loans. Why is this so important? Well, obviously, we would expect that as a result of COVID-19, the non-performing loans will increase again, and probably quite a lot. The question here is, of course, how do you deal with this? And the measures that were taken by banking supervision are not trying, at least this is what they say, and I think it's also what they mean, is not trying to evergreen actually non-performing, that you basically hide them, but there was some guidance given to use the flexibility in classification that is embedded in the regulatory system and also in the accounting system in IFRS 9, so the new accounting standards. So the supervisors show more flexibility in the early stage defaulting loans, what is called unlikely to pay. If the loans then subsequently default, well, then they default, and hopefully there will be no window dressing here, because that would be then a big problem further down the road. There was also a clear recommendation given to the banks not to pay any dividends, neither for 2019 nor for 2020, and to refrain from share buyback. So basically, the banks are told that the capital they have should be used for productive purposes, not to pay dividends for their shareholders. And then there were a few other smaller requirements that were eased. Is it enough? That's the big question for the banking system. And of course, nobody knows, because it depends on how long and how severe this recession is likely to be. And I took some inspiration here also from the ECB Financial Stability Review, but I added also a few things here that I think maybe have been a little bit overlooked, deliberately, I guess. There are still a number of important financial risks. So the first one is, of course, the link between monetary policy and financial stability. We know now for a fact that monetary easing will be there for even longer, and it will be an even more accommodative monetary policy for a long period of time. So that what it means for the banks is that this compresses, of course, their interest margin. And that's a problem for profitability. So, and it's unavoidable, but this is just corresponding tubes, so to say. So that's a challenge that is there. There is a renewed deterioration of asset qualities expected. So hopefully the flexibility measures will help to buffer this a little bit, but ultimately there will be substantial asset price declines, and that will hit the bank's balance sheet at some point. So this is again pretty much unavoidable. The question is just how big will it be? We didn't talk about public debt. I will talk about this in a minute, but as we know from the sovereign debt crisis, a huge increase in public debt has also negative spillovers on the banks. Hopefully less now, given that banking supervision has become centralized, but it is something that is that's a risk that is also there. And then again, I don't want to go into details. There are also issues here for insurers and also for shadow banks. But let me focus here mostly on the banking system. Let me then turn to the fiscal response. the fiscal response basically is like a drama in 3 acts. So the first act was very quickly. The first act was done by the European Commission, and they adjusted two very important rules in the European Union. The first one is that the Stability and Growth Pact rules were suspended. So that basically means that countries can now spend as much money as they want, and they can have a deficit which is as large as they want. So that's fine, because there was already in the EU law, there was a general escape clause that would permit this, but this was an important change, of course. The second, also very important, sounds very technical, but it matters a lot, is the relaxation of EU state aid rules. So under these relaxation of state aid rules, it is now possible for countries to have give much more far-reaching support to their companies than they would have been able to do in the past. There are some provisions here. So first of all, it needs to be demonstrated that these firms are actually viable, but well, we all know this is not always so easy to show. Nevertheless, I think it was right to do this. There's no doubt about it. You needed to do it, otherwise the countries couldn't have reacted appropriately. But again, you have certain side effects. So the overall use of fiscal capacity, of course, hinges on the national fiscal space. So some countries can do more than others. It's not a matter of wanting, it's a matter of being able to do so. And the relaxation of state aid rules will create distortions in the level playing field of the single market. So that may also be a problem going forward. Let me show you a little bit what is expected here going forward. So this chart shows you on the x-axis the general government debt to GDP ratio in 2019, and on the y-axis the forecast change in general government debt to GDP ratios. So what you see here is that some of the countries, and in particular those countries that already have a rather high level of government debt, are expected to add a lot more to this government debt. So Italy here is the most striking example. It has already around 140% of GDP, and is expected here, probably reality will be even higher, expected here to add another 25 percentage points to this figure. And for a lot of the other countries also, the increase in public sector debt is quite striking. And for the euro area as a whole, this is the yellow dot, it will be around 17%, something like this. That is, of course, quite severe. Now, of course, policymakers in the euro area and the EU were fully aware of this fact, clearly. And this is what explains Act 2 and 3 of this drama, so to say. So the second part of the drama, this came then already in March, so quite early on in the process. This is what I called here the loan package. So the loan package has 3 different components. There are loans from the EIB, the European Investment Bank, which are basically loans that can be given at very low rates to companies in the EU. So this is a EU-wide program. The second one is called Protecting Jobs. So this has actually been modeled on a German feature, which is called the short. In German, the translation from the German term would be short working scheme. So basically, people work less, and the government partly compensates this for a while. So it's a sort of short-term buffer instrument for labor markets. And this has now been rolled out to the EU as a whole. And the third one, and this is also something that's quite amazing, and it has been a bit overlooked. The ESM, the European Stability Mechanism that I mentioned earlier on, can now give so-called pandemic crisis support. So these are loans, again, at very low rates. and practically without conditionality. That is a real watershed compared to what you had during the euro area sovereign debt crisis, when countries like Greece or Spain needed to negotiate lengthy documents on all sort of measures that they needed to do in order to qualify for this loan. But this has been this all went out of the window very quickly. Now, all of these things are temporary, and they're all loans, right? So that of course is the major shortcoming of this. Because, as I mentioned before, if you have already highly indebted countries and you just add on more loans, well, okay, there's obviously a problem. And interestingly enough, after this package was decided already in March, there was a rather nasty, how shall I say, the political debate within the euro area and the EU became quite heated, and especially countries like Italy, but also some, for example, Spain, or also to some extent other countries, smaller countries, really complained that there was a lack of solidarity within the EU. Only loans were on offer, but no real redistribution. Now, in response to this is the third part, the final part of the fiscal story, and this is where we are moving towards grants. So in May, there was a Franco-German proposal for a 500 billion recovery fund, which would give exactly what was requested. So it would give grants to those sectors and regions most affected by COVID-19. So 500 billion is a pretty large abstract figure. So to put it into perspective, there would be around 3.6% of EU GDP, and that would be financed by the European Commission. Financed by the European Commission bonds. So the Commission would issue these bonds, and they would be very long, with a very long maturity, and guaranteed by the EU and its implicitly its member states. So the Commission has taken this idea, obviously, and has included this in its budget proposal. So this budget proposal would have been there anyway. It's the usual. The EU always has a 7-year long budget period. So the next one is 2021 to 27. So this was likely, or this was coming up anyway. But this 500 billion plus another 250 billion, which are loans rather than grants, have now been added to the budget on top of what would have normally been there. So again, I don't want to go into great detail. The distribution of this will depend, if the Commission proposal is adopted, ultimately will depend on the size of the economy, on the damage caused by COVID-19, on youth unemployment, which is a big problem in the EU still. And there will be some commitment needed here for structural reform, some budget adjustment, some environmental action, but it looks all relatively light, quite honestly. And again, the financing would be by long-term bonds issued by the European Commission. So, where do we stand on this? Well, this is something that is still now being discussed. It was actually only about a week ago, I think it was proposed. So the discussions on the budget are likely to take another couple of months. It needs to be adopted in the second half of the year. But quite honestly, in my personal opinion, the odds are pretty good that this will be adopted. First of all, the two largest euro area countries, France and Germany, are behind it. Secondly, there is nobody to blame. As I mentioned at the beginning of my speech, there is no argument now to say, okay, because Italy spent so much money, this is because COVID-19 hit them so badly. That just wouldn't make any sense, right? So there is a neutrality now in the discussion, and I think that is immensely helpful. So let me then conclude, because I think my time is also up. Just a few points to wrap up, and then hopefully we can have a interesting discussion about this as well. So first of all, of course, the shape and timing of the recovery, that will determine the nature of the crisis and also of the crisis response. So in particular, if it's a short-term, a V-shaped recession, so more a liquidity type crisis, then monetary policy can play a big role, and it will play a big role because the ECB has already done a lot, I would say. If it's an L recovery, or some other analysts said, well, maybe it's a sort of a kinked V or something that looks like this. You have a combination. It just takes longer as well. Then it becomes more a solvency issue, it becomes more a structural issue, and then you need a bigger role of fiscal policy to deal with the impact of this. So ECB monetary policy has been further eased already quite substantially. There are questions here, of course. One question, there's a lot of debate about this, of people that know much more about monetary policy than I do. Is there a declining effectiveness of QE? It has been used in the past. I would say it has been reasonably successful in Europe. But if you just use more of it, is there a declining returns, so to say? And we discussed briefly the political headwinds from Germany. I think it's not such a big issue, but it's something that is still there as a potential threat in the This is this Constitutional Court statement. There are financial stability challenges for sure. So profitability, the banks will struggle with profitability. They will also struggle with a renewed deterioration of asset quality. And they will probably also struggle, hopefully less than in the past, but to some extent they will, from the negative spillovers of the increase in public debt that we can expect. The fiscal response has been forceful. I think that's fair to say. Heterogeneous in parts, at least as far as the national responses are concerned, because simply some countries can afford to spend more money than others, and this may create problems in terms of the level playing field. But again, there are also positive spillover effects, so it's not necessarily a problem. And the EU level response in terms of the grants, that is still under discussion. But as I said, I think here I would be relatively optimistic that this will come to a constructive end. And that brings me also to the end of my presentation. Thank you very much.
Thank you very much, Rainer. Thank you. Please, colleagues, Rainer has given us a broad picture of what's going on in monetary and fiscal area in European community, and it was really very interesting. And now the time is to make comments and put questions. So you are welcome.
Yes, Alexander, it's Sergei Dubinin speaking.
Yes, you are welcome.
Rainer, about the possible inflation challenges as a result of this monetary policy and the state debt growing. Is it a real perspective for Eurozone? Please.
I think when it comes to the inflation, I don't see this as a problem for the next, say, 2-3 years, for sure. Simply because we are having such a deep recession now, right now, and probably the next couple of quarters, and it will take some time to rebound. So the forecast by the ECB, for example, doesn't expect a return of inflation to anywhere even close to the target within the next 2 to 2.5 years. And the ECB inflation forecasts have, if anything, consistently erred on the high side. So I think, of course, if you look at the really long term, this is an issue. This is clear because you're flooding the market with liquidity. So in the very long term, you need to see how you execute the exit from this. But I think the time to think about this is not yet there. It's something that I think safely we can discuss in 1 or 2 years, when hopefully then it's more of an issue. At the moment, I think it's not, quite frankly. On the debt, this is a very different story. I think here, this is indeed a problem. And it's a problem for some countries. And I think we have seen over the last 10 years, a couple of countries that got into serious problems, which led to a huge jump in public debt. So Ireland is an extreme example, but I could also think of Spain. And then afterwards, when this crisis is overcome and growth comes back at a reasonable pace, then there is also the chance to get rid of this public debt within a reasonable amount of time. The countries where I would be more worried about, quite frankly, one is Greece, simply because it's so large, and I don't think anybody really knows how to deal with this at this point. And the second one is Italy. Also there, it's very large, and the bigger problem that, for me personally, this is just my personal opinion, is that in Italy, I don't really see a realistic prospect for fast growth. But if you have a very high level of GDP and no reasonably fast growth, then there is indeed a problem. I don't know the solution, quite frankly, but that is something I think will be a difficult discussion. And this is also why it's so important that the support doesn't only come in the form of loans, but that there is a significant share of support that comes in the form of
grants. Thank you. Rainer, and what, in your opinion, are the prospects of GDP dynamics in Eurozone, in the European community? How important are all those measures from this point of view?
I was in the business of forecasting around 10 years ago, and I have to say, I always found it something very challenging and subject to a lot of uncertainty. But I don't envy anybody who needs to make a forecast now. So I think there's two aspects here. One aspect is a medical one. So it's something where we as economists have nothing to say. So let's first assume that this is more or less under control. That is the basis. Before that, nothing will actually happen. Now, if you ask me, the question I can answer you is, are those things that have been done helpful to support the recovery? And I think yes. I'm actually very positively surprised how much has been done in a relatively short period of time. And I'm also, I can say that I'm German national, I'm very positively surprised with the flexibility of my own country in these discussions, because in the past, Germany was always quite reluctant to go into anything that looks like a redistribution of burden within the European Union, right? And I think now the position of the German government is much more constructive. I also think that the ECB has done a lot on monetary policy to overcome the short-term challenges to liquidity. I think what was done on banking supervision is good. So I think the measures were right, but whether the medication will help, I think it's too early to say.
Thank you. Thank you so much. And if I may, I would like to ask one more question. What's your opinion? Will Great Britain be in a better or in a worse position now as compared to the situation when it was within the European community?
You're asking me a very emotional question for me, Alexander, because I studied for 2.5 years in the UK, and the UK is very dear to me. And I was very sad when they decided to leave. But okay, let's leave that aside for the moment. From an economic perspective, I think there is no doubt that both parties in this separation, in this divorce, are worse off than they would be otherwise. And I also think it was clear from the beginning that the losses are asymmetrically distributed, that more of the economic losses come to the UK rather than to the rest of the European Union. That's simply a matter of size and of trade. Now, will it be now worse than before? I think there are two important structural questions here on which this depends. The first one is, how will Brexit look like? I mean, I know we've discussed Brexit for 3.5 years, and at some stage it was just getting tedious and everybody wanted to switch off immediately when the word Brexit came up, but it's not done yet. The UK is out of the EU, fine, but they're still in the single market until the end of this year. And it is completely unclear what will follow. Whether this will be a hard exit from the single market, or whether it will be a free trade arrangement or something else. Nobody knows. At the moment, it doesn't look particularly good. So it could be that this is really a hard second Brexit, so to say, a Brexit from the common market, and that again would increase the costs for both sides, but again asymmetrically, in my view, for the United Kingdom. And the second point, and this is now a really completely different topic, I think the hope of the UK was always to say, okay, maybe we can compensate the advantages of EU membership by being very open, a very open economy in a globalized world. Are we globalizing? I'm not so sure whether this is really the direction where things are going. And if this is not the direction where things are going, then again, it will make matters worse for the UK. But let's hope for the best. I hope that reason will prevail and that a hard exit from the single market is not what will happen.
Thank you. Yes, colleagues, you are welcome to put questions and make comments. I don't see all of you, so please raise your hand with the help of this platform. You know how to do this. Or just begin saying, and then I will see who is doing that.
I have a little bit maybe naive question. What was the base for suggesting and accepting the measures you describe? Some modeling or calculation or just intuition?
I think that's a very good question, and I think it depends on which measures you're talking about. I mean, I know from my work at the ECB that these sort of decisions are, of course, based on modeling of the effects. And when it comes to the quantitative easing issues, that is something where the ECB has now around 4 or 5 years of experience, how to do this, and also how to assess the effect that it has. So I think there's a whole armory, so to say, of economic models that is behind them. But of course, at the end of the day, it's a political decision how big the program is. So how exactly was it decided that it was initially 750 and then again 600? Well, I guess there is a lot of discussion in the governing council where some members would say, well, we want more, others say we want less. I mean, that's clear. I mean, no model in the world would give you a point estimate where then people say that is the one. But there is a lot of economic thinking, a lot of modeling that goes into this. So that's for the monetary policy part. Banking supervision is essentially accounting. So that is relatively easy to do. You simply need to make a decision as to how, so when it comes to the capital buffers, how much you can reduce the buffers in order to be at a capital level that is still deemed as more or less robust. So for the macroprudential buffers, the decision was clear. I mean, by design, you build them up when things are good, when you have a strong growth, strong loan growth, and you release them when things are heading south. And this is exactly what they did. On the microprudential buffers, there's some judgment, but ultimately that is not difficult to do.
What about fiscal measures?
On the fiscal measures, that is the most tricky one. That is the most tricky one. And to be honest, I don't know how they came up, for example, the Franco-German proposal with the 500 million. I don't know, the 500 billion. It's something, my guess, but this is purely my guess, is something that you wanted to have a number that is impressive. You also wanted to have a number that seems reasonable from a euro area GDP perspective. So as I said earlier on, this is about 3.6% of EU GDP. So that would be equivalent to around 1 month of containment measure for the euro area as a whole, right? Whether this was actually an idea that came up, I don't know. maybe I'm suggesting too much rationality.
Thank you. Thank you.
Thank you. Yes, colleagues, you're welcome.
May I ask a question?
Yes, please.
Okay. Thank you very much, Rainer, for very interesting presentation. And my question is concerned with the thesis which you mentioned in the beginning about the less heterogeneity between the euro area countries, and it seems quite similar because the shock, of course, is now common. But what do you think about the future consequences of monetary policy? Because, of course, countries are in different positions from the point of view of government debt and so on. And by the way, it is also very interesting for me concerning these quantitative easing programs about the structure of the debt which ECB is buying, because of course there's public debt, private debt, and so on, and of course the burden of public debt and private debt can be different. And from that point of view, how can the perspectives for heterogeneity after the current monetary policy? Thank you.
Right. Thank you. It's a difficult question, of course. So, as I said at the beginning, the last couple of years were rather good in terms of heterogeneity. There was not so much of it, but the structural heterogeneity is still there. Now, I also think, to start with the more problematic aspects, the fact that countries like Italy and Spain were the worst affected by this crisis obviously does not help. And this is really unfortunate because I think it has nothing to do with their ability to deal with these issues. It's just that it hit earlier. So it's maybe just an element of bad luck, at least in the case of Italy. So that is the problem. Fine. Now, the long-term prospects of this. Again, I think there's two elements here that would give me some hope. The first one is that, as I mentioned, under this pandemic emergency purchase program, the ECB is now able to move away from this capital key allocation. So it can, at least for, but let's of course keep in mind, this is all about liquidity input, right? So this is nothing that creates a structural change. But I think over the next 2-3 years, so as long as this crisis is ongoing, let's hope it's not longer than that, I think this will allow the ECB to deal with possible spikes in sovereign spreads, for example. So from that perspective, I think it's a good short-term insurance measure. Now, the second aspect that is positive is that when you look at the EU budget, and if you look at this new grant facilities, the conditions that are likely to be used, it's still subject to discussion, but they would mean that the largest part of this funding goes to some of the countries that need it most. In particular, Italy would be probably the largest beneficiary of these additional funds. So that's good. The question then, however, is, of course, and this is always the black box, what do they do with it, right? So then it's about allocating this to the right purposes, making sure the economy becomes structurally more competitive and is growing more. And this is, of course, outside any crisis response, both from the monetary or from the fiscal side. I hope I answered your question. It's a little bit go around, but I think there's no easy answer to that.
Yeah, thank you. But maybe one more additional question. It is concerning with private debt. With public debt, it's more or less obvious for me. But as far as I remember, during the European debt crisis, some banking system in countries which may be not very much overburdened by government debt, like, for example, Ireland or Spain, faced with severe crisis within the banking system. What do you think about this possibility after this crisis?
Well, I mean, certainly for the countries that you mentioned, for Ireland and Spain, that problem is now much less acute than it used to be in the past, because the banking systems took the hit. They were seriously reformed. And I think that is no longer such a big issue. A problem, unfortunately, still exists in Italy, because the Italian banking system, progress was made, yes, but it's not comparable to what you see we have seen in Spain, in Portugal, or in Ireland. So the Italian banking system is indeed still a problem. I agree with that. And yeah, again, you need the right policies. You need to hope to make sure that the banks in Italy are not overwhelmed by a new wave of NPLs, which they cannot manage. That's a fact, unfortunately.
Thank you very much. So it seems like Italy like an Achilles heel now of the whole EU.
Well, let's just call it a challenge. But it is one, yes, for sure.
Alexander Mitch, можно?
Yes, please.
Again, thank you very much for your presentation. Very eloquent and structured and exhaustive. And you have touched upon many issues, and all of them are very important, not just from the point of view of analyzing the situation in the past months, but for casting some light on what can happen.
Alexei, some problems with your sound.
Following and even of the events in Karlsruhe. And all the discussion which followed the decision of the Constitutional Court of Germany with respect to the actions, to the activities of the European Central Bank. Could you elucidate a bit more what do you think? What consequences this decision may have? You said very rightly that it concerned more the program which started in 2015, but also it is very close to influence somehow to impact what the European Central Bank started to do in March this year. So do you think that there might be serious consequences from the point of view of next frame budget program, or from the point of view of banking union ensuing from this decision in Karlsruhe?
Okay, it's a good question. I mean, okay, so first of all, what is very clear is that this ruling doesn't only matter for the program that was started in 2015. This is very clear. It matters also for the current program. This has not been discussed now, of course not, but ultimately it is the same type of program. So it is clear that this problem, or that this court ruling needs to be somehow addressed. So the first question is, who can address it? It cannot be addressed directly by the European institution like the ECB. This is impossible. If the ECB would do that, and there has been some discussion about this, any national authority within the EU can come and request or question any activity by the ECB going forward. This cannot happen, and it will not happen. So it was always clear that the response really needed to come from the German authorities, and notably from the Bundesbank, the German central bank. This is, of course, also a little bit ironic, because the German government cannot tell the German central bank what to do. It's an independent institution, and this is a very important legal principle within the EU. So I think what will be done ultimately is a construction that will involve the Bundesbank as a formal respondent, so to say, to the Constitutional Court, and to the German government, and the ECB can respond to the European Parliament, and the European Parliament in turn has some legal link with the national parliaments. So there is some construction. I'm not a lawyer, right? But that is the construction that seems to be now emerging. So that there is a response to the GCC via that route. Now, that's a purely administrative argument, right? So what does it mean in practice, or what are the economic consequences of this? It's a little bit hard to say, and to be honest, it's not so clear why the German Constitutional Court has decided to do this ruling. There's been a lot of navel-gazing about this, a lot of soul-searching why they did it. It's not fully clear. So some people say they want to defend national sovereignty within the European Union. Some people say they want to defend a certain traditional type of central banking, but why should a constitutional court defend a certain type of central banking? So it's not fully clear. My hope is that, first of all, a solution to this particular ruling can be, an answer to this ruling can be found. I also hope that this is not something that will regularly come back whenever the ECB is doing something new along these lines. And I think that hope is not unfounded, because in particular for the COVID-19 pandemic and the central bank response, it brings me back to what I said earlier. There's no one to blame. right? So there has been a bit of a, how shall I say, always a bit of an undercurrent in Germany to previous ECB actions saying, well, the ECB is doing this to support countries like Italy or Greece or other countries. Now, this is clearly not the case for the COVID-19 campaign. So, but yes, I don't know. I mean, if it comes back to other issues, then there has to be something else found. Now, going a little bit beyond that, I think there is a positive note or a silver lining in all of this, because what this ruling has shown, maybe this was not the idea of the judges, but it's something that came out of it, whether they wanted it or not, is that there has been over the last couple of years an imbalance in euro area economic policy. There was basically no shouldering of burden on the fiscal side, so all the adjustment problems had to be taken by the European Central Bank. So, as some commentators said, the ECB was the only show in town. Right? There was not much happening on the fiscal side, and I think that this may be changing now, and maybe. I don't know, this is purely speculative, nobody made that link officially, but maybe the Franco-German proposal could be partly motivated also by this constitutional court ruling, by a realization that more needs to be done to achieve some degree of fiscal cooperation and coordination in order not to leave the whole burden to the ECB, which from an economic perspective doesn't make sense anyway, because the central bank can only provide liquidity, right? So that's a bit my take on it. Yeah, it's an interesting discussion.
Thank you very much. Very kind of you. Thank you.
Thank you. Yes, dear friends who would like to make comments or put more questions to Rainer?
Mike Zhernov is waiting.
Mikhail Zhernov, yes, you are welcome, Mike.
Then I saw Jamie Galbraith also wait with his hand.
With his hand? Yes, I see now. Yes. Mikhail Zhernov and then Jamie. Misha, пожалуйста. You should switch on your sound.
How is it now? Can you read me now?
Yes, it's okay.
Yes.
Yes.
All right. Well, let me say my thanks to our main panelists today, for absolutely excellent report, excellent presentation. I've got only one question. Look, I appreciate that under present circumstances, some easing of the banking regulations was something absolutely necessary. It was absolutely inevitable. We couldn't do anything about that. I mean, how we could cope with this crisis, some other measures, there's no way. But, well, however, I just wonder, this new level of flexibility of the prudential regulations of the banking sector, can it lead us to the new crisis? Instead of having, say, this pandemic, it seems that there are really very good chances of having financial or banking crisis instead of that. The quality of bank's portfolio is extremely, well, let me say so, not bad probably. It's not the right timing to give it right assessment, but it's really very, very vulnerable, let me say so, right? And on top of that, there's one more financial sector which is in an extremely bad situation. Now I'm in the insurance sector, which is under real threat. So I'm just wondering what kind of a situation on these two sectors we might have, say, in 1 year from now, when the maturity will will lead the borrowers well to pay their debts out. So I would appreciate your comments on this aspect. Thank you.
Okay, thank you very much. On your first question on the banking regulation, I mean, that I have to say is exactly also a concern that I have as a possible risk. So I think, as you also mentioned, I think it's something that needed to be done now. It's exactly the right thing to do. But is it really temporary? Of course, now they say it's temporary, fine. But it needs to be ensured that this is brought back afterwards, because I know in the euro area and in the EU, it took many years to have a reasonable amount of clarity, for example, on non-performing loans, and that would be a big step back if we do this. Now, maybe just one point to add to this is that, of course, SSM is not acting here alone. I mean, it acts in tandem with recommendations by the Basel Committee, with the IMF recommendations, and so on. And I actually spoke just today on a different topic with a colleague from the World Bank who was looking at such schemes with a focus more on actually Central Asia and Western Balkans. So they do some work there. And he said they are quite worried that some of the banking adjustments, so to say, banking sector regulation adjustments, actually go as far as simply doing away with the transparency that we had achieved. So that is very worrying. And I hope this is just individual examples, and I hope it's something that will be brought back into line once COVID is over. But yeah, no, I think it's a big issue and needs to be careful here. Insurance sector, yes, I fully agree with you. The insurance sector has already been, at least in the EU, but also in other parts of the world, has been under a lot of stress before. In particular, the life insurance sector. What is happening now will make it worse. There's no doubt about this. I didn't go into any detail. I also I don't have so much information about this. It's something that in the European Union is dealt with on a national basis. There is basically no uniform supervision for insurance, for the insurance sector. So that's just a national task, so to say. But yes, I agree with you. I think the insurance sector is definitely an issue. Another sector that has also now shown to be potentially quite a problem is the shadow banking sector, at least some of the shadow bank funds. So at the beginning of the crisis, they suffered a lot from big outflows, so people calling back their assets. So also there are some risks, but I thought here I'd focus mainly on the banking sector.
Thank you.
Thank you.
Jamie, you're welcome.
Thank you. I have to say, first of all, that I sympathized very much with the difficulty that you had in responding to Victor Polterovich on the question of how the fiscal number was arrived at. 12 years ago, I asked the exact same question to a senior member of the Senate staff in the United States as to how they'd come up with $700 billion for the troubled asset relief program. And the answer I got back was, well, it's less than $1 trillion and more than half. And I thought, gee, that's arithmetic. I could do it myself. The whole premise of your talk, which is very interesting, is based upon
basically a bifurcated possibilities. One is the possibility of a V-shaped recovery. And I think much of what you've been saying about, and just now about insurance and shadow banking is true even under the V-shaped scenario. But I've been studying the other possibility, which is the properties of the Roman letter L. And it seems to me that the L is no recovery at all. Essentially, that's what an L means, essentially, is that it gets flat, goes to the bottom and stays flat. My question is, how long does one have to wait before you decide whether we're in a V or an L, and I say whether we're recovering or not recovering? And if we're in an L, how much worse is it? I mean, if, for example, we talked about the Italian banks, is there a large German bank or two that would be in trouble with its derivatives in an L-shaped situation? And if so, how long does it take to find this out?
Well, this is hard to say, of course. I think an L wouldn't be, I don't think we would have a proper L. We would have probably something where the lower part of the L is still somewhat upward sloping. It just means it would be something where the recovery would take quite a bit longer. When do we know about this? I don't know. Let's repeat this session in 6 months or in 9 months, and then I think we know quite a bit more. On your question about the German banks, well, yes, I mean, Germany actually never had a particularly great banking system. The advantage of Germany was that, and still is, that it has a good real economy and it has a strong sovereign. So when there were problems in the past with the public sector banks in Germany or with the Commerzbank, the then second biggest bank in Germany, the government could simply bail them out. It's as simple as that. So now, of course, Deutsche Bank is also not exactly in a great shape, which everybody knows. So yes, if we are facing a very L-type or very long depression, then I think some of the German banks will also get into trouble. And incidentally, the German banks have probably the ones that have been complained most ferociously about the impact that the ECB monetary policy has on them, which is also one of the reasons, I think, why the German Constitutional Court has ultimately taken the decision against it.
That's interesting. I just, as a question for a policymaker, one of the arguments I've tried to make, and with absolutely no success in this country, on repeated occasions, is that one should, faced with this kind of uncertainty, act as if the worst case scenario were the correct one. And then if it turns out not to be true, you can always pull back. But if you act as if the better scenario is the correct one, and time goes on, the problems get deeper and deeper, and end up with much more difficulty going forward.
I think that
I've never succeeded in getting that point across, but
oh no, I think it makes sense. But honestly, I think what has determined largely, I think the response on the ECB side, but also on the side of the governments, the fiscal response, is of course always what is, especially on the fiscal side, what is politically feasible, right? And in a way, I have to say, and I think I mentioned it before, I'm positively surprised how much has been done. And I think that's simply in recognition to the fact that everybody knows this is a major challenge. So even in the best of times, and more than that, I think simply wouldn't have been possible at that stage, right? But of course, if say in 6 or 9 months, we realize we are still much more in an L rather than a V scenario, then I'm sure more needs to be taken and probably will be taken. But yeah, that's an interesting point.
Thank you.
Thank you. Yes, colleagues, you are welcome. More comments?
Can I ask a question to Rainer?
Yes, please.
Thank you. Rainer, that was a brilliant presentation, really. And I have a question on the quantitative easing and monetary policy. when you think about negative interest rates, it makes people run from the money, banks run from the money, and you have to make them take this money. So after the recovery, whether it be U-shaped or V-shaped, will the economy get on the previous rate of money generation and money demand? Or will there be long-term changes in that? Will you have to put in place some measures to make the economy take your money, make the interest rates more negative, even more than the cost of holding the cash money, I mean the paper money? Or do you foresee any measures to use monetary policy outside the current agenda? Some totally new policies implemented? Thank you.
Yeah, I mean, to be quite honest with you, I'm not really so deep into the discussion on these completely unorthodox monetary policy measures. I know there's a lively discussion going on about helicopter money. There is a lively discussion going on about central bank digital currencies, which is something that some people think this may be a good way to execute this. There have been also some already or some experiments, I would say, in some countries with outright negative interest rates. To the extent that I know, this has not really been a great success so far. I know that in Sweden, the Riksbank has abandoned it, for example. They said, okay, this is not helpful. So the way the ECB has tried to circumvent the problem is to use these long-term refinancing operations, where, of course, you have negative interest rates, but for the banks. So it's something that gives a strong incentives to the banks to get this liquidity. If it's a targeted operation, it comes also with the explicit requirement that the money needs to be, liquidity needs to be used to hand out loans. So I think that's the way to do it. There were some discussions in the euro area also about outright negative rates, but that, I think, also given the fact that the euro area is still somewhat heterogeneous, of course, I think that would be politically even now probably not acceptable. So so the ECB is trying to use this as a go around, so to say, to avoid that problem. That's all I can say on that.
Thank you. Thank you. Any more questions or comments? And are there estimates, Martin, about the financial situation of the real sector of the economy in the EU? What are the prospects? And the problem of non-performing loans is related to this one.
Yeah. There are no estimates on this. I know that at the ECB and in some of the national central banks, there's a lot of work currently going on analyzing non-financial corporation balance sheets exactly to find out what is happening there, because the colleagues working there are quite worried that this NPL wave will be much larger than what is currently now hoped or expected. But I'm not aware of any measures that has been released. There may be within the next 1 or 2 months. I think the ECB will release some aggregate assessment of this. At least this is what I was told. But there are quite a few countries currently what they call firm stress tests, basically. So balance sheet stress tests for the banks. I haven't seen any results of this yet. I know this is ongoing at the moment. But that's the way to do it, because as you say, Alexander, I think That's an absolutely key question to know what is likely to come from in terms of defaulting assets. And then, of course, you can calibrate or you can scale the regulatory response to some extent accordingly.
Thank you. Thank you. Dear colleagues, any more comments or questions? I don't see raised hands.
I've exhausted you.
Oh, probably Jamie keeps his hand raised. Okay. Okay. Well, so it was an excellent presentation, very interesting one, and I appreciated it a lot, and I'm sure my colleagues have appreciated it also. Thank you. Thank you so much, Rainer. And next time we meet in a week at 6 p.m. Moscow time, as usual. And as I've already mentioned, the topic next time will be that of socio-economic consequences of pandemic for the modern Russian society and households. And it will be presented by Marina Pisklakova-Parker. She is a senior researcher of the Gender Studies Division of the Institute. And also I believe that this is, as far as I understand, that this is a joint report by Marina and Vyacheslav Lokosov, the director of the Institute. So hope to see you next time. So now, thank you so much, Martin. Thank you.
Thank you very much for the invitation. Really enjoyed it. Thanks for the great.
Thank you.
And, you have my contact details at the end of the presentation. So if any of you would like to continue the discussion, feel free to contact me. It will be a pleasure to be in touch.
Thank you so much. And of course, we're going to put Rainer's presentation at our site, where all the materials of our conference are concentrated. We have quite a lot of materials there, by the way, so you can see it. And I haven't mentioned, but I thought it was taken for granted that Professor Martin is also our visiting professor at Moscow School of Economics. So thank you so much once more.
You're very welcome. Thank you. Thank you.
Take care and be healthy, all of you.
You too.
Thank you. Thank you.
Thank you. Bye-bye.
Thank you. Bye.
Thank you.